Gautam Adani's companies have lost a staggering $107 billion in market cap in less than a week. Arguably one of the biggest crashes in Indian history.
The timing of the report's publication clearly betrays a brazen, malafide intention to undermine Adani Group's reputation with the principal objective of damaging the upcoming follow-on public offering from Adani Enterprise.
The most controversial group in the Indian stock market is back in the news, as international short seller Hindenburg released a 130-page research report citing its concerns with the group and declaring an all-out war with the company by shorting it through US-traded bonds and non-Indian traded derivative instruments. The entire report highlights how hollow the entire group is really despite their sky-high valuations. The 7 parts that make up the whole study are the outcome of a 2-year thorough investigation into the group. Let's take each part one by one. As per Indian listing rules, any publicly listed company has to float at least 25% of its equity to the public. This move is intended to ensure a minimum level of liquidity, reduce insider trading and market manipulations. Now coming to the Adani Group. 4 of their listed companies are on the brink of delisting due to high promoter ownership or basically less than 25% ownership given to the public. The report has identified 5 funds based in Mauritius that have about 95 to 100% of their holdings invested in only Adani stocks. These funds have been linked to Gautam Adani's elder stepbrother Vinod Adani, who operates the various Adani private offshore trusts and uses these 5 funds to funnel the money back into the publicly listed ones. In addition to that, the promoter pledge ratio is a fundamental metric used by analysts to check how much of the debt taken by a company has been secured against its shares. The format has now been actively used by Adani to generate money for the business. But the real pledge ratios are higher than those stated. According to the research, these funds have also pledged their stakes. However, none of the public disclosures have disclosed these numbers. Now coming to the stock parking entities that were identified, there were 4 of them, namely Monte Rosa Holdings, Elara Capital, New Liena Investments and Opal Investments. Monte Rosa Holdings is actually an independent group operating out of Switzerland, but it's linked to the Adani Group as the 5 funds that were stated to have heavy holdings in the company are all belonging to this entity. These funds collectively held about 1.69% of Adani Enterprises, 5.09% of Adani Transmission, 2.72% of Adani Total Gas and 1.29% of Adani Power. The concentration of such large amount of holdings in just one group is far beyond normal investor behavior. Elara Capital PLC is allegedly a second Chinese wall, which is intended to conceal the identity of Adani. As per Trendline data, 99% of its holdings are invested exclusively in the Adani Group. Secondly, the report highlights a series of leaked emails that imply the connection of Elara's CEO to Dharmesh Doshi, who was accused of running a wide-scale stock operation scam along with Ketan Parekh. This scam involved rigging Indian markets and pumping several stocks, including those of Adani Exports. The third entity is New Liena Investments, a Cyprus-based investment manager with a 1% stake in Adani Green Energy valued at $420 million as of June 2021. New Liena Investments has been linked to Amicorp due to the same address and contact numbers as well as the confused responses received when contacting them. Amicorp, a provider of incorporation services, was a significant player in the 1MDB global fraud. The company created investment funds for the main offenders that served as simple means of laundering a client's assets through what appeared to be a mutual fund. The last entity identified was Opal Investments. Opal Investments holds a 4.69% stake in Adani Power. Now that is an issue because the fund is actually owned by the Adani Group and is directly eating into the public share. Hindenburg identified a major link between any shell company and Adani, which was their incorporator, TrustLink International Limited, and the CEO of TrustLink is also a board member of the Adani Group. About 30 to 47% of the delivery volumes of Adani shares were accounted for all by these organizations in a coordinated manner. These trends indicate that these organizations may have been used to artificially inflate the volume and price of some Adani listed companies. This isn't the first time that the group has been accused of stock manipulation. In 2001, stockbroker Ketan Parekh was banned from Indian markets for 14 years on charges of rigging the prices of at least 10 stocks, including Adani Exports. The stock price of the company registered a 162% gain in a matter of 6 weeks between November and December 1999. On being questioned about their involvement in the scam, the group replied that the main motive behind their dealings with Ketan Parekh was to finance a startup operation at Mundra port in Gujarat. The SEBI responded that the stock market is not intended for financing transactions. After a long deal of negotiation, the punishment was reduced to fines by April 2008. Another instance of Adani's involvement in market manipulation happened less than a year after their acquittal in the Ketan Parekh scam. In June 2009, SEBI began issuing prosecution notices against 34 brokerages, brokers, and individual traders, including 21 separate investigations alleging that they were complicit in creating artificial volumes and contributing to a 128% increase in the price of Adani shares in less than a month. In recent times, it's believed that money trail of the Adani Group still leads to Ketan Parekh. Even though Parekh was banned from Indian markets, it is believed that he still operates from London and the Adani Group is still connected to them. Ketan Parekh's daughter's LinkedIn profile, which shows her serving 6 months as a researcher in Elara Capital, which is allegedly one of Adani's many stock parking entities, was one of the pieces of evidences suggesting the same. In part 3 of the report, it has been highlighted that Adani used its complicated corporate structure to move capital back and forth through a series of undisclosed related party transactions, which is a clear violation of the law. All of the group's offshore entities are used to do shady transactions and funnel assets in and out of the Adani Group companies in India. Vinod Adani, Gautam Adani's senior stepbrother, appears to be in charge of the majority of these. Some of these shell companies had registered websites set up to give the impression that they were legitimate, but that is certainly not the case. The first and foremost link between all the entities in Mauritius was TrustLink Investment Limited, and all of these entities were listed at the same address. The second link was that the companies situated in Dubai specifically mentioned that they don't accept any third-party funds except for the promoter, aka Vinod Adani. The second shell situated in Dubai is a steel company in the same residential tower as Emerging Markets Fund DMCC. Now, one such major transaction highlighted was a loan of 79 billion rupees given by Emerging Market Fund DMCC to Mahan Energen, a subsidiary of Adani Power. With no employees, no clients, and no deals, how did Emerging Market Investment DMCC get such a massive amount to loan to Adani Power? This is just one of the many transactions that have been explained in detail in the report. Now, before we go back into the report, if you liked our videos so far, don't forget to hit that subscribe button to stay tuned with our upcoming videos. And now going back to Hindenburg. This section of the report highlights the major fundamental red flags in all of the group's companies that have massive accounting irregularities hiding in plain sight. First, there has been a massive turnover in CFO roles. Adani Enterprises has changed 5 CFOs in 8 years, which suggests major accounting and internal financial control issues. And the same pattern is seen in other Adani listed companies as well. The second red flag is their audit firm. Most large corporations hire credible and well-known auditing firms to give investors confidence that their financials are being reviewed independently. It's reasonable to expect a large, experienced auditing team at a company as large as Adani Enterprises, which has 156 subsidiaries. Instead, they have a tiny auditor firm, Shah Dhandaria LLP, that oversees audits of 2 of their public companies. This tiny firm operates out of a small office in Ahmedabad, with most of its partners under the age of 30, lacking the level of experience or seniority needed to seriously scrutinize one of the world's wealthiest and most powerful businessmen. This is just the matter of 2 of Adani companies. The other companies have their audits performed by Deloitte and Ernst & Young. In that case, Adani Power's FY22 report shows that the auditor provided a qualified audit opinion, and according to him, Mundra Power's net worth had been completely eroded due to sustained losses. This part of the report digs up some of the skeletons in the closet in order to make a stronger case against him. The Adani Group has repeatedly faced numerous allegations of corruption, theft of taxpayer funds, and siphoning from listed companies. One of the major scandals being the diamond scandal spanning 2004 to 2006. Under this, Adani Exports, now renamed Adani Enterprises, was under the scanner for engaging in circular trading of cut and polished diamonds, overinflating the value of goods, which led to a hollow rise in its export turnover, all on the back of his wide network of shell companies all across the world. The flowchart that was found during this investigation is actually what helped Hindenburg connect the dots for their current investigation. Even a fundamentally sound stock may be overlooked if it does not receive adequate analyst coverage. In this context, analyst coverage refers to the opinion or recommendation published by major brokerage houses or mutual fund managers. The lack of analyst coverage on Adani stocks appears to be a calculated choice rather than a limitation. Adani Ports appears to be an exception due to its highly valued assets and actually great valuations as evidenced by its inclusion in the MSCI index, but it appears that the release of this report did not spare the company as well. Second, the majority of mutual funds chose to forego superior returns in order to avoid the group, which must be for a very good reason because they are obligated to provide extensive disclosures about the technical and fundamental rationale before selecting a stock, which they seem to lack when it came to Adani. The final part of the report, which they are now experiencing firsthand, is Adani's lack of appetite for constructive criticism. In late 2020, Adani Group wrote a letter to Law Minister to check into a Twitter outrage against Adani's Australian coal project. The response seemed to be something like this, which is quite similar to the response they have provided in the 400-page response to Hindenburg. This behavior is exactly why the Adani Group caught Hindenburg's eye, because companies engaging in such bullying practices generally have a lot to hide. This was the entire report's synopsis, and by the end it was difficult not to take a side. It is true that these allegations are not unique to the Adani Group. There are many other companies in India and possibly all over the world doing the same thing. But you cannot tease the top 1% of the world purely based on inorganic growth. The report caused the Adani Group stock to drop more than 100% in just 2 weeks, which had a cascading effect that caused the group's FPO to be cancelled and major foreign banks questioning their faith in the conglomerate. In conclusion, siding with Adani and hoping it survives is unquestionably the need of the hour. Otherwise, we face a systemic collapse of our economy. However, such hollow growth was bound to see some correction. And if such behavior is encouraged in our markets, we may have harmed our country's credibility in the international market, which could be much worse for the economy.